Imagine this. The stock market drops 15% in December. The mutual fund you've owned for 10 years is now worth less than it was in October. And then, right before Christmas, you open a 1099 tax form from that same fund and find out you owe federal tax on $40,000 of capital gains. A gain you never saw. In a year, the fund you owned is actually down. Sounds insane, but it happens to mutual fund investors every single year. It's called a tax bomb. And in this video, I'm going to show you exactly how it works, how to spot one before it goes off, and why the true cost of owning some of the most popular mutual funds in America is 2, 3, or sometimes 4 times higher than the expense ratio you see on the prospectus. I'll also walk you through a free tool inside Morningstar that almost no retail investors use, but every wealth manager I know runs before recommending a fund. And by the end of this video, you'll have a clear framework for deciding when it actually makes sense to bite the bullet and sell a mutual fund, even when sitting on a 6-figure embedded gain. Quick word on me before we dive in. I'm Andy, a wealth manager at VDB Wealth. I help families clean up their portfolios that have grown messy and tax efficient over decades. And a lot of what I'm covering today is exactly the work that I do on any given week. So let's get into it. Here's the plan for this video. First, we're going to touch on what a mutual fund tax bomb actually is in plain English. Then we're going to talk through the real total cost of owning a mutual fund, which is almost never just the expense ratio. And then third, we're going to jump in and find out how to find a fund's tax cost ratio on Morningstar in under 30 seconds and what you should do with that number. And for a simple break-even framework for when it makes sense to sell, even when you're starting at a giant embedded gain and a scary looking tax bill. Let's start with how mutual funds actually work, because the tax problem comes straight from the structure. A mutual fund is like a pool. Hundreds or sometimes hundreds of thousands of investors share ownership of one basket of stocks. The fund manager buys and sells positions inside that basket all year long. When the manager sells a stock at a profit, the IRS treats that as a realized capital gain. But the fund itself does not pay the tax. The fund passes that gain through to whoever owns shares on a specific date in December. So here's where it gets ugly. The IRS does not care if you own the fund for 30 years or 30 days. If you own shares on the record date, you get a slice of the year's realized gains and you owe tax on it. That is true even in years when the fund is down. It's true on the first day you own the fund. Let's say a real example. In 2021 and 2022, dozens of large actively managed equity funds distributed 10 to 15% of their net asset value as long-term capital gains. If you had $300,000 in one of those funds, you got a 1099 for somewhere between $30,000 and $45,000 in gains. At a 23.8 federal rate, which is 20% long-term capital gains plus the 3.8 net investment income tax, it's roughly a $10,000 federal tax bill on income you never asked for and you never actually pocketed. Once you add in California state tax, you're looking at north of $14,000 out of pocket. That is a tax bomb. The second version of this trap is what we call an embedded gain. When you buy into an older mutual fund, you're buying into all of the unrealized profit already sitting inside it. The day you buy, you are already on the hook for the manager's future selling decisions. Some legacy funds today are sitting on potential capital gains exposure north of 40% of net assets, which means almost every half of every dollar in that fund is unrealized profit that could be distributed at any time. So why does any of this matter? Because most people, when they look at what a fund costs, look at one number, the expense ratio. The prospectus says 68 basis points. You nod, you move on. The expense ratio is one piece of what you actually pay every year. It's not the whole picture. The real annual cost of owning a mutual fund in a taxable account is roughly the expense ratio, plus the tax cost ratio, plus internal trading costs that come from turnover. Let me show you actual Morningstar numbers. Let's take Vanguard's total stock market index, with the ticker VTSAX. Expense ratio is 4 basis points. Morningstar's 3-year tax cost ratio is roughly 46 basis points. Total drag, just over 0.5% per year. Now compare that to a typical actively managed equity mutual fund. Morningstar published a 10-year study showing the average mutual fund gave 1.9% per year to taxes. Equity ETFs, by comparison, gave up only 70 basis points. When you stack 0.75% expense ratio on top of that 1.9 tax cost, you are paying roughly 2.6 per year in real annual cost before you have even seen a single dollar of market return. That 2.1% per year is the number that matters. On a $500,000 taxable portfolio, that is $10,500 every year. Compounded over 20 years, it's 7% pre-cost market returns, and the active fund investor ends up with roughly $580,000 less in the bank than the index fund investor. Same starting capital, same market, very different ending number. And here's what makes me a little crazy. The tax cost is sitting right there on Morningstar. It's free, it takes 30 seconds to look up, and almost nobody does it. So let me show you how to. Go to Morningstar.com, type the ticker of any mutual fund into the search bar. For this walkthrough, I'm going to use AGTHX, which is one of the American Funds Growth Fund of America. It's one of the largest actively managed equity funds in the country. When the fund page loads, you'll see a row of tabs across the top. Quote, chart, fund analysis, performance, sustainability, risk, price, portfolio, people, parent. The tab you want is not the one you'd expect. It's price. Click it. Before we even get into the tax data, look at the top left. Maximum sales fee. Front load 5.75%. For the A shares class, that is a one-time 5.75 sales charge that comes off the top before your dollar starts working for you. Put $100,000 into this share class without a load waiver, you are starting with $94,250 invested. That's a piece of the total cost picture most people never look at. Below that, ongoing fee level. The expense ratio on this fund is 59 basis points, which Morningstar flags as low for its category. So far, so good. The expense ratio is not the problem here. Now scroll to the bottom right of the price tab. You'll see a small box labeled taxes. This is where the real story lives, and it's the part almost nobody looks at. 3-year tax cost ratio. Fund 2.06, category average 1.37. Let me translate that. Over the last 3 years, an investor in the highest tax bracket who owned AGTHX in a taxable account lost 2.06 of their annual return to taxes on the fund's distributions every single year. The average fund in its category lost 1.37%. So this fund is roughly 50% more tax expensive than its own peers. So if the fund returned 10% pre-tax in a year, the investor in the top bracket took home closer to 7.94% after tax. On a $500,000 position, that 2.06 drag is over $10,000 every single year gone to the IRS. Now look at the second number, potential capital gains exposure, 64%. That is the embedded tax bomb. It means 64% of the current net assets of this fund are unrealized gains sitting on the books. 2/3 of every dollar you have in there is a profit that hasn't been distributed yet, but could be at any time. If the manager has a heavy selling year, or if the fund sees big redemptions and is forced to liquidate positions, those gains come out as 1099s, and you owe tax even if you didn't sell a single share. So 2 numbers. 1 tab. Tax cost ratio is the past damage. Potential capital gains exposure is future risk. If you want to round out the picture, click over to the portfolio tab for turnover, which tells you how fast the manager trades inside the fund. But the headline story lives on the price tab. If you only remember one thing from this section, remember this. Go to Morningstar, look at the price tab, look at the taxes, and you'll figure out everything you need to know within 30 seconds. It's totally free. Now the question I get more than any other. Andy, I hear you, but I have $400,000 in this fund and $200,000 of it is embedded gains. If I sell, I owe $48,000 in tax. Why would I ever do that? And it's a fair question. And the answer, just so you know, is all math. Here's the framework I actually use with clients. The math is simple. If you sell, you pay tax. If you don't sell, you keep paying the tax cost ratio every single year forever until you die or until you finally sell. So the real question is, how many years of avoided tax drag does it take to break even with the cost of paying the tax now? Let me walk you through the same example. And let's say the position is the AGTHX we just looked at on Morningstar. $400,000 position, $200,000 embedded gain, $47,600 in federal tax to fully liquidate at the 23.8% combined rate. You move into a tax-efficient ETF with a tax cost ratio of 30 basis points instead of the 2.06%. That's 1.76 in annual tax savings on $400,000, which is just over $7,000 a year. And that savings grow as the portfolio grows, just under 7 years. After year 7, you're objectively better off having paid the tax. If you're 65 years old with a 25-year time horizon, that's not a close call. There are 5 situations where I tell clients selling is the right call, even when the tax bill looks scary. 1. You have current year losses elsewhere in the portfolio that you can offset the gain. Tax loss harvesting on one position can fully cover the gains on another. 2. You're just in a low income year. Maybe you just retired, your earned income dropped, and you're temporarily in the 0 or 15% long-term capital gains bracket. For 2026, a married couple with a taxable income below $98,900 pays 0 federal tax on long-term gains. 0. 3. The fund is sitting on enormous embedded gains that are likely to be distributed anyway. You're choosing between paying tax on your terms or paying tax on the manager's terms. I'd rather control the timing of paying tax. 4. You plan to give the position to charity using a donor-advised fund. That wipes out the embedded gain entirely. You get a deduction at a fair market value, and the charity gets the full amount. 5. You can spread the gain over multiple tax years. Selling a quarter of the position each year for 4 years can keep you in a lower tax bracket the whole way through the process. On the flip side, here's when I tell clients to hold the position even though it's a total mess. 1. You're over 75 and the step up in basis at death is close enough that your heirs would inherit the position with 0 embedded gain. The IRS resets the cost basis at death. 2. The fund is held inside a tax-deferred account like an IRA or a 401k. The tax cost ratio is irrelevant in a tax-deferred account because you're not paying tax on distributions year to year. You also can trade out of it without paying tax. 3. Your income this year is unusually high and waiting 1 or 2 years drops you into a much lower bracket. The right answer is rarely all or nothing. Most of the time, we're scaling out of a position across 2, 3, sometimes even 5 tax years. We try to pair gain harvesting with loss harvesting. Try to use charitable giving where it makes sense. Could be a multi-year plan and not a single trade. So, let me wrap things up. 3 things to remember. First, the cost of owning a mutual fund is not just the expense ratio. It is the expense ratio plus tax cost ratio plus turnover costs. For a lot of actively managed funds, the tax cost alone is larger than the expense ratio. You can be paying 2 or 3% a year and you don't even know it. 2, Morningstar gives you the data for free. Pull up any fund, click the price tab, and scroll to look at the taxes box in the bottom right. 3, the decision to sell a fund with embedded gains is just a math problem. Don't make it emotional. Run the break even. The years to break even are shorter than your time horizon. You almost always come out ahead by paying the tax now and reinvesting in something tax efficient. If you're sitting on a taxable account right now and wondering whether you've been quietly bleeding money to mutual fund taxes for the last decade, I want to hear from you. Feel free to send me a note or you can book a call from the link in the description. I'll personally take a look at your situation and determine the right next steps. Thanks for watching this video. If you got value from it, please click like and subscribe, and I'll see you in the next one.